Good morning, everybody. It's Hammer. Today is Tuesday, March 11th, 2025. I, of course, am here with your daily mortgage rate update, the only place on the web where you can go ahead and talk what's going on with markets and rates and pricing each and every weekday morning. This one's got a weird bow to it. I got to give it a little more. There we go. That's a little better. I don't know. I've already had a bit of a rough morning this morning. How's your morning going? Let me know in the comments. Curious how y'all are doing. It's 9:30 a.m. Eastern time. It's actually 9:36 because things have just been going a little hectic this morning. So I appreciate you being here and being patient. Remember, if you're watching on the replay, give me a hashtag replay in the comments. Don't forget to smash the like button, tag a fellow friend, share the post in a group. Go ahead and say hi to all the live folks here this morning. Mike Tebow, good morning, sir. James Mahan, great to have you here. Mallory Fotiatos and Glenn Boussard, good morning. Brandy Brickler, great to see you as well. Amy Blouser, good morning. Take a look, y'all. There you go. Take a peek. That is the guys working on the barn. That's going to be where the new office is going to be. It's going to be up there. And you can't really see much here, but it is going up and moving along, which is fantastic. However, I was helping them get some lumber up there with the tractor, and there's the tractor in front of the truck. And I had a flat with the tractor this morning. Looks like I picked up a nail, which is not a big deal. But when I drove on it, didn't realize it had gone flat and a lot of weight on it, and popped it off the bead, and then had to reseat the bead, and then had to do this and do. But I'm here. So thank you for your patience. Good morning, Yasmin. Good morning, Candido Diaz, Angela Walters, Tina Brumond, Daniel Crowley. Great to have all of you here. All right. Well, since I'm already late, enough jibber jabbering, let's jump right in and talk about what's going on this morning. Good morning, Megan. Good morning, Megan Lindbergh. So mortgage-backed securities down 16 basis points on the day, showing a little bit of stagnation here. The 10-year Treasury yield, though, 4.23. This is important. The fact that the 10-year Treasury yield continues to hold, I'm going to put this here and make you guys stare at me while I do this with you. The fact that the 10-year Treasury continues to hold in that 4.20-ish level is a very good sign. The fact that it's not back up above in 4.30 and like that. So take a look at this 200-day moving average, this line right here. We broke above it for a couple of days last week. Remember, with yield, we want to go down. That's why these candlesticks are green, moving in a downward trend. This is the 10-year Treasury yield. All right. We want it to stay below 4.24. That is the line in the sand for the 200-day moving average. So we're going to be watching this closely. I think it will continue to move lower. However, it may bounce higher. Now, remember what's going on. So the reason we're seeing bonds doing well is basically all the headlines now are like Chicken Little, the sky is falling kind of headlines, right? So, U.S. stocks slide amid recession worries. It's amazing how quick they blew the mothballs off the word recession. Here it was, they called it the Trump trade. We're going to have just money flowing everywhere. Businesses are going to make a ton of money. Stocks are doing well. Equities are amazing. Now, all of a sudden, everything's selling off. All of these articles, so funny. It shows just how quickly these storms roll in. And, now they're talking about recession worries. Citi downgrades U.S. stocks while Wall Street set to pause the sell-off. Uncertainty over tariffs and government job cuts pushed the S&P 500 into one of its worst weeks this century, 25 years, relative to the rest of the world last week. Right. We jump over to this article. Traders search for havens as U.S. stock sell-off rattles nerves. Now, here's what we need to be kind of aware of and how it affects mortgage rates. When stocks do poorly, we used to say, well, when stocks do poorly, bonds do well because traders need a place to put that money. They put that money into safe havens, bonds, but that's not what's happening now. Right? It's a global economy now. So a lot of money is going into other places, from ditching U.S. stocks for Chinese peers, other Chinese stocks, to buying the yen and the euro. Traders are running for cover as they ponder how a U.S. market's meltdown may unfold. Steady selling in U.S. stocks turned into a stampede on Monday as recession jitters. And it's like a huge thunderstorm, hurricane rushing in and just flooding everything. And all of a sudden we went from optimism and tariffs are going to drive up inflation and the economy, and now all of a sudden it's like, well, we're going to be in a recession, right? um, Recession jitters spread across Wall Street, risk aversion spilled into Asia, growing conviction, the U.S. exceptionalism. I love how they use that term, U.S. exceptionalism, and they don't really use it in the right thing. They're almost using it as financial, and it's really not, but it spurred a rush into the relative safety of the yen, Australian government bonds, and offshore yuan. Notice what's not here is you don't see a rush into mortgage-backed securities. You don't see a rush into 10-year treasuries. And because of that, that's why we're not seeing the benefit of all these economic fears. Now it will come and it will continue to come, but we need to watch. And if tomorrow's inflation, we're going to get CPI inflation data tomorrow. If that data comes in hot again, like it did last time, remember the last time that we had a really bad day? That was right here around that data, February 12th, right? When was the CPI data? CPI release dates 2025. So the February data, the January came out February 12th. And when we look at February 12th, right here, we had this ugly down candlestick. Now, after that, we got a bounce back the next day, and then it came up, and then we've seen, things go since then. However, we may see more of that. So you want to consider that if you've got any loans that are risk averse or closing soon, and you don't want to take a chance, because again, mortgage bonds have still stalled. Here we are at 101.47. Yesterday we ended at 101.59, and my line in the sand remains around 101.50. If we can't see bonds, break above and stay above 101.50, and that's right about where we're at right now, 101.47, we're within a couple basis points there, give or take, right? But if we see this continue to move down, it may, I wouldn't be depending on tomorrow CPI data to bail us out, because we don't know how it's going to come in. Now, we can argue that it's a very shelter heavy data, and depending on how, you've got this stuff that falls off and this stuff that comes in and all that kind of thing. But at the end of the day, that everyone thought that's what was going to happen last time, and it came in hot. So I wouldn't be betting my stuff on that. You may want to lock some loans closing near term if you don't want to take the risk that we may start to see rate sheets slip a little bit. I mean, looking at rate sheets, 6.72, we're on the lower end. The best we've seen was 6.70. And, we're kind of on that same area here. If the CPI data comes in hot, though, it's not going to, rates aren't going to take off. It's not going to go see rates shooting up, but we may lose some pricing. But overall, I wouldn't be in a hurry, like, it's not like some huge urgency. I'm not like, guys, you gotta lock. It's just that if it's risk averse, if it's closing soon, consider it. Otherwise, we'll see how all of this continues to play out, because it's kind of funny. I mean, Wall Street fears Trump will wreck the soft landing. The economy's pilot has a new message: fasten your seatbelts. I was also reading this morning about, let me see if I can find it in the Wall Street Journal's main thing here. It was about the that people, the borrowing is ending. I thought I saw it on here. Yep, here we go. All right, so consumers keep bailing out the economy. Now they might be maxed out, and this is a big deal. This is what we've talked about it, the credit bubble. And if that credit bubble pops, now you're going to see that R word, recession, really jumping up. Recession fears rekindle concerns. Americans are overstretched on debt. American consumers and their credit cards have helped the U.S. economy weather many a rough moment. Now, as recession fears resurface, the worry is that they might be maxed out. The stock market's plunge has been broad, but it has been sharper in a few sectors. Among the most notable is consumer lending. Major lenders and credit card companies were all down more than 4% on Monday. So far this year, those four are down an average of 12%. So you know what will happen? You will see inflation fall if people don't have money to spend. It's all supply and demand. So if supply goes higher than demand, and demand is beaten because people don't have credit to use to buy things, you're going to see inflation fall, tariffs or no tariffs. So looking at all this stuff, it's all kind of, this is the overall outlook that we have. Good morning, Jerry Avila, Allison Foy, Christopher Griffith. Good to see you, sir. Alan Christian. What's up, sir? Almir, Krivdik, Tim Kleila, John Jones, Mark Clark. Great to have all of you. So again, these are all coming together. The overall outlook is still rates will stay near where they're at, could possibly improve. If we do lose a little bit of ground with the CPI data tomorrow, it's going to be temporary, because then you'll see more of this. You're going to see the media really jumping on this. And again, it's almost self-fulfilling as it starts to roll and snowball. As we see more talk of recession, as you see speculation from the markets that the Fed is going to have to cut rates. Remember, 4.25 is where they're at right now. By the end of the year, markets think 1 rate cut, not enough. 2 rate cuts, barely, maybe. 3 rate cuts are the minimum. Right? When you round up everything that's here, when you add up everything that's here, you got 25% right here with 1 or 2 cuts. 2 cuts is 25% or less probability. 3 or more cuts, 75% probability. That's what markets are pricing in, and they're going to continue moving in that direction. They're going to go ahead and drive the 10-year back down into that 3 area if we see continued talk of the recession. What we'd really like to see a break is we'd like to see a break below 4.24 and stay down there for longer. We broke it here on February 28th, which was a Friday. We stayed below it on that following Monday, and then we lost ground, and it's really just been struggling to there. So we only had a couple of days that it was below that, before. We need to see it significantly drop down and continue going. What would do that is if we do see economic weakness. JOLTS data comes out this morning, by the way, at 10 a.m. That could reverse the 13 basis points being down if we see some weakness in the number of job openings or in labor turnover. That could give us a little bit of a boost this morning and help erase some of these basis points. So hold off from locking anything, at least see where the day goes. Decide if you're going to lock anything ahead of tomorrow's CPI data. Anything you do lock before that data, I would make sure it's only things that are closing near term and very risk averse. Otherwise, the bigger picture, we're likely to see bonds, escalate a little bit better. Again, we should be seeing it sooner, but what's happening instead is money is going into other markets outside of here. There's a lot. Remember, the bond yields in Europe are doing better because everyone is concerned that Europe is going to have to raise a boatload of money. They're going to have to take on a lot of debt in order to increase their war machine to support Ukraine, since the U.S. is not doing that. We were carrying a lot. And we'll see where all this rolls. So that's it, my friends. That's what we got going on. Hopefully, if you got any questions, let me know in the comments. Curious to see what y'all have going on. Again, I'm getting my new barn built, which will be where my office goes by the middle of the year. I'm excited about that. The kitchen is the kitchen living room is looking like an actual kitchen and living room. I'll give you some fresh pictures tomorrow, but put some new carpets down, put the furniture back, still working on the cabinets and, countertops and everything. That'll be a while. I'll be working on that. So, but most of the heavy lifting is done there. I got most of the cabinets in. I got to finish the island. All the cabinets are in place, but they're not all screwed together and screwed to the floor yet. So, all right, my friends. Well, I'm going to wrap it up. Thank you again for joining me. Appreciate all of you. I hope you have a fantastic day. As far as Rocket and Redfin, who cares? Go get business, right? I mean, unless it's going to affect you personally, why are we I mean, you can gossip about it a bit, but certainly don't give it more time than it deserves. And let's go out and get loans. There are loans, especially when you see that article talking about the maxed out consumer. Consumers have a lot of equity, and they're going to need to free up cash flow, right? So, here we go. Where is? Oh, this is an interesting one too. Stocks chart dramatic U-turn from record high to recession fears. How quickly did that happen? Isn't that crazy? Isn't that just absolutely nuts how quickly that we've gone through this whole, roll through on this? It really is. It's almost laughable. So, but where's the one that I wanted that talked about that's the Wall Street Journal article. Duh. So here you go. So I mean, nope, that's that one. Consumers keep bailing out the economy. There's loans out there. So go get them. I'll catch y'all later. Hope you have a fantastic day, my friends. Bye-bye.